Hello everyone, welcome back to Fundrise Finance. After what seemed to be a good rally that was in the making, starting mid of March, where the market had climbed almost 6.5%, the bears seem to have taken back control, and the market is back almost 5+% down. So overall, for the last 1 month, if you see, the market has barely moved. It's just up 0.8%. We have the latest inflation numbers where it rose 8.5% for the month of March. So the inflationary evil is around us all the time, waiting to eat away into our returns. So as a dividend investor, we need to be very, very careful in choosing our stocks. In this video, I will go over 5 such stocks which I feel are undervalued at this moment and give a very good buying opportunity. Let's check it out. And if you're new here, please consider subscribing and hitting that bell icon so that you are informed of all such informative videos in the future, and that will help grow this young channel. Before going further into the video, let's see how my picks for mid-March of 2022 are doing currently. So we had Morgan Stanley, T. Rowe Price, Air Products and Chemicals, American Tower Corporation, and Best Buy. Of all these, only Best Buy seems to be the laggard, giving a return less than 1%. After that, we have Morgan Stanley. In the last 1 month, it has given a return of just 0.05%. And then we have T. Rowe Price at 1.48. And then we have American Tower, which has done really well at 8.77%. And Air Products and Chemicals has really done well. It has given return of more than 13%. So anyone who would have invested mid-March into Air Products or American Tower would have got a good decent return by now. In fact, all of these stocks are still in a buy territory, but may not be really a great value as much as they were a month ago. In fact, I have a few of these even in my current list. So keep watching till the end of the video to know which of these make it into the current list also. The first stock on our list is Cummins Inc., ticker symbol CMI. Cummins is a multinational corporation that designs, manufactures, and distributes engines, filtration, and power generation products. This company is from the industrial sector and plays a key role in many of the industries actually running. It has a market cap of $27.65 billion and currently gives a yield of 2.96%. It has a very good PE of 11.28. Year to date, Cummins has fallen almost 11%, and last 1 year over 25%. The last 5 years, it has given return just over 33%. It has a dividend growth rate of 7.07% and a very good payout ratio at just 38.38%. It's been growing its dividends for the last 3 years. Track Your Dividends gives Cummins a dividend score of 86 and considers it to be undervalued by 28%. But as per my own dividend calculations, which considers the current yields and the future growth, I calculate it to be undervalued by 14% with a fair price of $223 with an expected 5 year average growth of 17%. Cummins has a very good yield and inflation matching dividend growth rate, and with the price taking good beating right now, it's a very good entry point to get into. The next stock on our list is JP Morgan Chase from Financials. JP Morgan Chase is a multinational investment bank and financial services holding company. It has a market cap of almost $374 billion and provides a yield of 3.17% currently. Year to date, JP Morgan has fallen 22%. The last 1 year, almost 17%. The last 5 years, it has returned almost 47%. From a dividend standpoint, it has a 5 year dividend growth rate of almost 15% with a payout ratio below 30%, which is really good. And it has been paying its dividends for the last 9 years. Track Your Dividends gives JP Morgan a dividend score of 80 and considers it undervalued by 30%. But as per my calculations, I consider JP Morgan to be undervalued by 16% with a fair price of $146 with a 5 year average growth rate of 14%. Overall, JP Morgan Chase is a very good financial stock to hold and in fact buy into at the current price point. It has a market beating yield. The dividend growth rate is very good. The payout ratio is very good. So one should make use of this opportunity to buy into. Next, we have T. Rowe Price, ticker symbol TROW. T. Rowe Price is also from the financial sector, and we also had it as part of our mid-March dividend pick list. T. Rowe Price has a market cap of $32.7 billion and currently gives a very good yield of 3.45%. Year to date, T. Rowe Price has fallen almost 29%. In the last 1 year, it has fallen almost 21%. In the last 5 years, it has returned almost 95%. From a dividend point of view, it has a 5-year dividend growth rate of over 15%, again, with a payout ratio just under 34%, which is really good. It has been paying its dividend for the last 36 years. So T. Rowe Price is a dividend aristocrat, which means it is part of the S&P 500 and has been consistently growing its dividends for more than 25 years. Tractor Dividends gives T. Rowe Price a dividend score of 68 and considers it to be undervalued by almost 40%. But as per my dividend calculations, I consider it to be undervalued by 18% with a fair price of $164 and an average 5-year growth of 20%. The fourth company on our list is Starbucks Corp, ticker symbol SBUX. Starbucks, as you all may know, is a multinational chain of coffee houses. It has a market cap of just over $93 billion and currently provides a yield of 2.47%. Year to date, Starbucks has taken a real beating, falling almost 32%. Last 1 year, it has fallen almost 31%. In the last 5 years, it gave a return of almost 37%. From a dividend standpoint, it has a 5-year growth rate of 15.87%, so it is almost double that of the current inflation. The payout ratio is also very decent at 56%. The ideal one should be below 60. It has been growing its dividends for the last 11 years. Tracker Dividends gives Starbucks a dividend score of 80 and considers it to be undervalued by 36.5%. But as per my dividend calculations, I calculate Starbucks to be undervalued by 25% with a fair price of $99, giving a 5-year average return of 19%. The last stock on my mid-April list is Morgan Stanley, ticker symbol MS. I had Morgan Stanley also as part of my mid-March list and is still very undervalued at the moment. It has a market cap of almost $148 billion, giving a yield of 3.3%. Year to date, Morgan Stanley has fallen almost 15.5%. In the last 1 year, it has returned 5%. In the last 5 years, the return is more than 104%. From a dividend standpoint, the 5-year growth rate is really good at almost 27%. So it's more than 3 times the current inflation rate. The payout ratio is also amazing at just over 26% and has been paying its dividends for the last 8 years. Tracker Dividends gives Morgan Stanley a dividend score of 75 and considers it to be undervalued by 8%. But as per my dividend calculations, I consider Morgan Stanley to be undervalued by almost 27% with a fair price of $107 and a 5-year average growth rate of 15%. So these are the 5 companies that we just discussed. To recap, we have Morgan Stanley, Starbucks, T. Rowe Price, JP Morgan, and Cummins. I know we have a more financial tilt this time. That is because all the financial stocks have taken a real beating year to date and provide a very good buying opportunity. And with the Fed expected to increase its rates over the rest of the year, we may see financial stocks also doing good. So this is a good time to buy into financial stocks where the buy points are really attractive. Hope you like this video, and I would really appreciate if you could hit on that like and subscribe buttons, and also provide in the comment section what you liked about this video and what changes you expect to see, and any other topics that you want me to cover, which I'll try my best to do. So until we meet in the next video, let's try as much as we can to be financially healthy. See ya. Bye.